On CNBC-TV18. Well, Harish Krishnan is now joining us. He's Executive Vice President and Senior Equities Fund Manager at Kotak Asset Management Company. Harish, good to have you with us here. Thank you for your time. Just a quick word on it's just something we started talking about in the show, which is defense and specifically shipbuilders. Our colleague Parikshit was talking about how, as part of that the India-US joint statement after the Prime Minister's visit, shipbuilders perhaps get a boost because a large proportion of U.S. Navy's fleet, what's in work is that they will get serviced, repaired, etc. At these shipbuilders. Now, that's a first, according to some experts that we've spoken with, and opens up a large opportunity set. You are someone who looks at numbers bottom up. Have you looked at, stocks like Mazgaon, etc., companies like Mazgaon, and what's the potential here? How much is being already priced in after the run-up?
So, without getting into stock specific, as always, Prashant, I think defense is an interesting space, primarily for the fact that there is a greater scope for indigenization, which is basically that there is a lot of imports that happens in defense, and if that can be value added in India, and that's really the broader narrative that we have as far as defense is concerned. Now, whether it being in the form of, say, shipyards, or it could be in the form of, say, even, for example, MRO facilities in the aviation sector, or it could be in the form of, say, explosives and ammunition, which otherwise were imported and now being value added. I think there is a whole range of opportunities that have opened up. Having said that, of course, this is driven entirely by the government. And generally, we've seen that, government based companies typically tend to have a lumpy kind of a revenue and ordering profile. When times are good, I don't think one should extrapolate it beyond the recent time frame to believe that this will be the new trend. The case in point I would like to make is that defense as a percentage of GDP, and whether we look at India or across the world, has actually started coming off. So while it is a topical point of today, especially with what's happening in Europe and Russia, I think one shouldn't get carried away. There are various parts of the economy as well, which are, wherein spends are growing faster. And I would think that given that those would be more driven by consumers, possibly they would be a better or a far more predictable kind of in terms of valuations. So we have exposure to defense names, but I would say after the run-up, we would like to temper down expectations.
All right. Hi, Harish. Harish, give us your view on the banking space itself. What's your take out here in terms of a pecking order? That was the consensus buy. We've gone to a phase of more or less some consolidation. How do you approach that space from here? Are you looking at some of those private sector banks that have underperformed? Do you believe the PSU banks still have value out there?
Right. So I think the consensus, and we share the longer term optimism on financials, which is clearly that our overall leverage is quite low, and therefore credit growth can pick up meaningfully in this decade. And a lot of cleanup has happened, which means that at least at the start of the cycle, things will be a lot more rosy when it comes to the profits pools that can come through. And before the credit cycle starts moving a bit adversely. So I think the key question is how much of this has already been priced in. I don't think we differ with the prognosis that it's all very good for the banking system. I guess the issue is more, like I said, in terms of how they've already run up, as well as in terms of the ownership in the space, wherein most of the fund houses, both domestic and international, have a meaningfully large position. Just another important point I would want to bring out is, if you look at profit as a percentage of GDP for the banking system, just for the banks, it's now running close to about 1% of GDP. And this is at its highest that we've seen in the last 20 odd years. So they are, at the end of the day, cyclical names. Of course, I'm not saying that one can't go to 1.2 or 1.3, but one needs to be mindful that one is buying it close to the top of the cycle. The entire economy has to grow for much more stronger for the banking sector profits to continue to keep growing at 15, 20, 25% thereabouts. So those are the two observations that we have as far as the banking sector is concerned. NBFC, of course, given the fact that interest rates are likely to head lower, I think they are likely to be better off with a slight improvement in their NIMs. And assuming that the overall economy holds forth, I think NBFCs are in a better spot at this point of time, especially given the fact that over the last 2, 3 years, they have kind of underperformed the banking space.
Sorry, Harish, just to clarify, you said banking profits are about 1% of GDP, and that's the top of the cycle.
That's right. Over the last 20 years, that's where it has been. So this is, of course, only the banks. I'm not including the non-banks.
Got it.
Got that.
Harish, hi. So to be here. Just wanted to get your thoughts on this whole new age part of the market, right? Morgan Stanley came out with a note and they sounded a fairly optimistic sort of note on just the profitability trends and the fact that almost all companies cutting across sectoral lines, now they're focusing a lot on this balance between growth and profitability. What is your stance? Have you been accumulating anything? Because, stocks fell off a cliff, but since then, several like Paytm, for instance, they've had a pretty decent run.
So I think we continue to be selective over here. Our stance is that these are great optionality instruments in the sense that obviously some of them can create tremendous value, and therefore it makes sense to buy them as a basket rather than buying them and assuming only one or two and have a concentrated position. So we've got a basket of these new age companies in few of our portfolios, especially which have a technology bent mandates, in their offerings. I think, given the funding winter that we are seeing, there are broadly two costs that any new age company, has. One is in terms of employees, and second is in terms of cost of acquiring a customer. And both of them are trended down quite meaningfully given the funding winter that's happening. And therefore, companies which will see through on the other side, I would think have a very large opportunity to create value for the shareholders. The only negative, if one may, is that there is a significant amount of supply by various private equity and various other investors on the venture capital side, which obviously keeps adding to the supply. But by and large, I think that it's at least about 3 or 5 of these new age companies can potentially create significant value over the course of the next 3-5 years.
Harish, talking about the supply that we've seen from large private equity players or even, VCs, there have been a slew of block deals. The latest one was in Landmark, but prior to that it was in Sansera, Kim's, Shriram Finance, HDFC AMC. A lot of the domestic mutual funds were buyers in, these block deals which took place. Were you interested? Did you buy did you lap up a large chunk in any of the stocks? And if yes, without naming them, if you could give us an indication where you found the valuations attractive enough to buy.
So we've been selective. So we've participated in some of these deals. I think from a supply point of view, clearly, there are two kinds of supply, right? You've got the primary issuances of stroke IPOs, and then you've got the secondary sales by existing shareholders, especially on the private equity venture cap space that come off to offload some of these. I guess as far as the primary market is concerned, we haven't seen too many new issuances, and that's possibly a good sign because the cycle is just starting to warm up over the course of, possibly the next 6-9 months. We would see a lot more issuances coming there too. As far as the secondary supply is concerned, I think our primary interests are in spaces which are different from our existing portfolios. So if we already have a lot of financials, are we adding on to financials names? Possibly not. But if there is something which complements our existing portfolio and where we were finding it difficult to build reasonably large quantities given the liquidity, I think those are the areas that we've kind of added over these last 2 months, where there has been, as you rightly pointed out, significant amount of supply by existing investors.
Okay, Harish, thanks so much for stopping by and filling us in with your take on the markets as well as individual sectors. Wishing you a good evening, and we look forward to chatting up with you rather soon. By the way, when we're having that chat with Harish,